G'day guys, this is Money in the Tank. My name's Joel Seach, advisor.
And I'm Chris, tax professional.
And this week we're discussing all things property 101 and really delving into what property is and how it works and how it operates, mainly in Australia and a bit of domestic stuff in general.
Yeah, and then we get stuck into some great Q&A, so thanks for everyone for the questions. And then we hit up the either or for the week, which is a doozy.
Yeah, hang around for that, absolutely. It's divisive.
All right, Jolie, welcome back to another week of Money in the Tank.
Yes.
How's your week been, mate, and how's your weekend? We're recording this on a Sunday, so...
Yeah, absolutely, Arnie. Yeah, just good weekend. Really busy. Good to hear your voice again, mate, and catch up for another pod. Yeah, man, had a good weekend. Just been hanging out with the kids, doing a few bits and pieces. We went out to Erin and I actually had a night out last night in Richmond, which was awesome. Just did some Vietnamese in Victoria Street, and then we hit up, went back to Sporting Globe just for a drink and watched some of the basketball because we couldn't actually try to get tickets to the basketball, but. Sold out. So
who was playing in the ball?
They've got the doubleheader Melbourne Cup sort of thing going at the moment in the NBL Cup in whatever the Rod Laver's called John Cain now. So they're just doing double headers. All the 10 teams are here, so they're playing basketball most nights. So last night I think it was Melbourne versus Sydney, but there was one before it as well. But called up to check if we could get tickets, and they're all sold out. I think because of the capacity issue at the moment, it's a battle. They're only doing 50%, which makes it probably a bit harder to get tickets.
Oh, it's a bummer that you couldn't go, but also Sporting Globe, good venue to watch at anyway.
Yeah, absolutely. So it was great, man. It was really good setup and able to chill out there and have a couple of drinks and finish the night off and just escape from the kids for a bit, which is good. How about yourself, dude? What have you been up to?
Just took it pretty easy yesterday. Newborn's been keeping us awake, so I was a bit sleep deprived from the night before. But during the week, caught up with a few of the boys. Went to this joint in Ringwood called McKelly's. Good pizzas and good parmas. If anyone's listening wants to check it out, so that's what I've been up to, mate.
Never heard of that one. I'll have to check that out, my friend. And I feel you. I feel you on the lack of sleep deprivation, mate. I don't miss that.
Oh, I'm struggling, bro. Anyway, so this week, what are we talking about?
Yeah, man. So I think we had some great feedback from really stripping back the share segment last week from Shares 101, and just. I guess just trying to hit up a baseline of, novice to intermediate, what shares are and how they operate. So we had some good feedback on that. So this week we thought we'd touch on Property 101. So really tried to explain the nuances of property investing, how it works, how it operates, where you can look, where different states, different postcodes, different regions, how they work, return on investment, we'll get yourself to touch on as well, and just more broadly the topic of property, because I think in Melbourne and in Australia in particular, property is one of those things that is always a hot topic, and I think always people talk about it and people think about it, and whether it's your own place or whether an investment property, I believe property is an integral part in the Australian culture. So I think it's a great topic to really break down as a bit of a 101 subject for this week. Yeah,
so you're spot on there, Joel. I feel like Aussies love a bit of property. An anecdotal example during the week, talking to Cappy about two different properties, one in Alinda and one in Tasmania, both 640,000. One was on 18 acres and one's on 850 square metres. So it's like, what you get for your money can be wildly, it can vary wildly is what I'm trying to say.
Yeah, for sure. And every state in Australia, every capital city, every region is all different. And I think sometimes that's the misnomer with property in Australia is sometimes if you look to the news sites as your main source of information, you can get a little bit misled because they'll tend to headline grab. They'll tend to grab a snippet of, let's say, a great auction clearance rate in Melbourne, and that doesn't necessarily translate to Western Australia, Perth, for example. So every state and every capital city, but also every region and every suburb can actually be quite different in Australia more broadly and historically. We're in probably a little bit of an aberration at the moment because property is doing quite well everywhere in Australia, more broadly. Most of the cities and capital cities and regions And the states are doing quite well and experiencing some growth after the pandemic last year. And even the pandemic last year, some states didn't really drop off at all and actually increased. And that's sometimes the scary thing, that if you're watching the headlines or watching the media, you end up getting misled a touch, because economists from, let's say big instos, the big instos all had their say last year on the economists, I should say, from the big instos, and what they thought property was going to do in Australia more broadly. And sometimes if you look back and you can see the past 10 months, one of the analysts I saw the other day had changed their thinking about 4 times. They started with a -20, went down to a -10, then turned into a +4, and now it's up to about a +16. So they've oscillated about 30% in the space of 10 months. And I know we're going through a crazy period, but really, if you're an economist and you're trying to give some feedback or some research or some evidence on property or your thoughts on it, then you've got to be a little bit more accurate, you'd think, than what they actually said they were.
You're right. We can't be too harsh on them because the pandemic created a lot of uncertainty, but that is a huge variance, 30% in what they thought was going to occur versus, where they think it's going to go now. So maybe I'll touch on my rudimentary understanding of how you might analyze an investment property, and you can correct me where I'm wrong, and then we can as far as I understand it, the way you want to think about it is looking at the revenue, the expenses, the cash flow, and then what kind of return on investment you're going to be getting. So obviously the revenue would be the rent that you would collect, and that's going to vary by postcode. It depends on where you are versus how much you can collect. And then you need to think about the expenses. So some typical expenses that might pop up in property, and feel free to jump in here, Jolie. Rates, insurance. You might want to account for some vacancy costs, meaning that the property may not have a tenant for the full 12 months of the year. Repairs, capital expenditure, you might want to put some aside. So, every 10 years, the property needs something done with the roof. So you want to account for that each time you're bringing the rent in. So it's not such a big expense all in one hit. You might want to pay a property manager, or you could manage the property yourself and save some money, but expend some time. And then obviously the big one is the mortgage payment. So have I missed any key ones there, Jolie?
Yeah, I think from what I heard, you kicked off most of them, and I think the property thing is another thing that sometimes people don't account for. And I don't know if you mentioned it was the depreciation schedule.
Oh, I didn't. No, good call.
So that's something that's actually off the books as a deduction. So when you buy a property, you can get what's called a depreciation schedule for capital and what's it called, capital and contents works, or works within the property. So you can actually depreciate a property from its life cycle. So I think it runs for 20 years plus, and it's not money that you actually have to fork out. So it's not like you have a toilet breakdown and you've got to go and send someone there to fix it and get a replacement and a plumber and whatnot. It's actually part of the build cost. So you've got the ability as an investor, whenever you purchase this property during the cycle, to depreciate the actual building works themselves, and it's something that you don't have to physically fork out each year. So it could be, as an example, $4,000 the first year, and it slowly trends down over time, and it's money that you actually get back without having to pay physically that money out.
Yeah, so if you were building a brand new property, you'd be able to depreciate the whole thing, or if you were doing an improvement to an existing property, so something like you were building a big veranda and pergola, you would be able to depreciate the cost of that. Is that correct, Jolie?
Yeah, that's it. And even if you buy a second-hand property, so to speak, so let's say something that's 10 or 15 years old, there's still some depreciation schedule left on that people don't realise. You can actually get a schedule on that and depreciate that over time as well.
Yep, that's a good point.
Yep.
So then
and there's scrapping too. So if you have to get rid of things, there's sometimes some money you can add to those items that you're scrapping. So yeah, there's a bunch of expenses that you can claim with investment properties, but then there's also physical outgoings as well, which you touched on. So your management costs and vacancy rates is a big one. So yeah, you probably have to factor in maybe 3 to 4 weeks as an average each year, and it won't always be every year. You might have a great year one year, then you might have vacancy for 10 weeks in the next year, but average sort of 3 to 4 weeks is probably maximum. You'd hope. Usually it probably averages out more around the 2, but I think it's always good to conservatively factor in that little bit little bit sort of extra vacancy.
Yeah, that's right. So then what you would do after you've got those figures that we've just talked about is you would look at how much you bring in every month. So let's just say it's, I don't know, $3,000. And then you add up how much your expenses are each month. And it might be positive cash flow, it might be negative cash flow. So just for the sake of an example, say the expenses are $2,500 every month. You take $2,500 away from the three and you've got $500 worth of cash flow. And then to work out your return on investment, you'd want to be looking at what your down payment was for the mortgage, any of the extra costs associated with it, like maybe you had to do some repair work on the property before it was fit for rent. And then add all that up, compare that to your cash flow figure, and then you can work out a percentage return on investment.
Yeah, so the capital growth and the rental yield are probably the two biggest factors when you talk about investment returns. So when you talk about rental yield, so let's say your purchase price for a property in suburb of Melbourne, $1 million. It's not unusual to find properties in the outer ring of Melbourne nowadays for $1 million. And let's say your rental for that is maybe $30,000 a year. So as a simple formula, that's 3% of the property. Now, if you were to spend, let's say $2 million on a property or $1.5 million on a property, and that rental yield was only 35 or 40 grand, it means your percentage of rental yield comes down. But if you were to find a property in, let's say, the outer ring of regional Victoria, and that property was 500,000, and your rental yield was, let's say, 20 grand, then you're looking at a 4% rental yield. So generally, it's got a bit of a correlation there that the more you spend, the rental yield doesn't tend to go up as much as you spend on the property. So the actual percentage yield comes down a touch.
And you're also mentioning the capital yield there, Joel. So the capital appreciation,
capital
growth on a property. How do you work out the yield or the return on investment in that?
Yeah, so the capital growth is one of those things that you take it year to year, so you'll eventually work it out over a period of time. It's always hard to do it on a short-term basis, but you can look at a longer-term basis for a property capital growth. So if you're buying a property for X amount and you hold it for 5 or 10 years and you look back over that period, you can work out your average capital growth appreciation. And that's the thing that all the states, as I was mentioning before, have really different capital growth appreciation. So for example, take into account or take out of account this year and the last 6 to 12 months where it's been a bit sort of crazy. You look at Adelaide as an example, South Australia, they tend to tick along at a fairly conservative rate and they don't fluctuate as much. Whereas examples, Sydney and Melbourne, up and down, pretty crazy, and they have your big pockets of growth and then you have some flat periods. And even Perth, I think during a period of the past 10 years, it had some negatives in there as well. So some really different operating mechanisms when you talk about capital growth, and every state, region and capital city does it slightly differently.
That's really interesting. And I was just sort of jogging my memory here. I remember talking to a mate at work about property investing, and he was saying when you are looking to purchase an investment property, one thing you want to be looking for is what might drive the capital growth. And I'll give you an example. He buys properties in Tasmania, and he's an avid mountain biking fan. So shout out Adam if you ever hear this, but he tends to buy properties that are near major mountain biking event sort of circuits. And I forget the name of the town, but he purchased a couple properties in this town where they were building a lot of infrastructure, and a lot of money was being invested into this mountain biking race, I guess, like as a bit of an event location. So he bought a few properties thinking, he could get maybe some tenants in there permanently, or people who want to go there during the event season to rent it out Airbnb style. So I guess like that sort of brings me to that point of, you could think about that always when you're looking at a property, about what good things are around this property they're going to bring people or bring renters. It's an attractive area for them to move into.
Yeah, absolutely. So your friend there was at Adam. Yeah, so he's talking about what's called growth drivers. So growth drivers are really what drives property prices, and you've got there's so many moving parts to it with growth drivers. You just mentioned one of those was infrastructure, and that's really a really key one. So if you've got a lot of money being spent through there, so government money on roads, infrastructure, schools, those types of things can really help drive growth. Because let's say you're living an hour away from where you need to work, and previously, where you needed to work was you needed to go 5 days a week. Now that can be a little bit different now, and you're seeing people, move regional and move out to the suburbs because they don't need to live in such a close proximity to work. But just in general, if they're creating really good infrastructure around you and it minimises your commute into wherever you're needing to get to, or they're building big shopping centres and almost making these satellite cities around you, that can really drive growth because people don't need to go into the CBD anymore, or people don't need to travel as far because they've got all this infrastructure around them, or they've got roads to get to the airport if they need to get away. So there are all those real drivers, and then you've got schools that come off that. You've got job growth and work around that. So they're all the things that help economic activity really thrive, and it really can really help push as a driver for capital growth of an area.
Is there an easy way to do any kind of due diligence on those capital or those growth drivers? Like, where would people go to look?
Yeah, so there's a few areas. So you can look more broadly at what the state is planning on doing. So they usually have big spends on certain areas. Then you can delve into, once you've found, let's say a state's looking at doing a big freeway or doing a big, piece of infrastructure around a certain area, you can then drill into the actual council or that local shire itself and see, what the vacancy rates are like. You can, vacancy rates is a different thing, I should say. You can see what the jobs growth is like. You can see the people moving to the area. You can see things like council developments or planning. So there's a bunch of things. If you drill into the council, you can see the amount of land that's open. Then you can also go to places like census, and that's where you can see things like rental versus owners. You can see population growth over a period of time in that certain area. So you can actually really drill in to specific suburbs and locations. Probably you start more broadly and then you work in to narrow down.
That's really interesting. Now that you say it, it kind of makes sense, but I didn't really think about it. Like, it's sort of, when you're approaching it as a novice like I am, it seems quite overwhelming. And I imagine there's probably some good resources out there on the internet where you could be guided by the things you want to look at, maybe plug it into a calculator or do a bit of analysis on those aspects.
Yeah, so you got to be careful because, if you get a property and there's a lot of spruikers out there and people trying to take advantage of general folk. And if you get the wrong property and you pay overs for it, it can really set you back a number of years. And when we talk about, as we've mentioned before on the podcast, investment lifetime and time frame for investing is such a key thing, especially when you're young, when you're 20s, 30s, 40s, you've got a good amount of time. And if you set yourself back 5 or 10 years, it can really take away from your eventual outcomes. So being mindful and doing your research and due diligence, reading your books, like we've said before.
Rifkin's Rules.
Rifkin's Rules. Yeah, Rifkin's Rules, mate. Get the convertible. Convertible front cover of that photo. If anyone wants to Google Rifkin's Rules, it's quite funny.
Mate, before you jump back in, I'm going to post that to our Instagram page. Check out Money in the Tank. That's going to be the first photo. Rifkin's Rules.
Yeah. That was one of my first book shares. Just a big dude with a big beard sitting out the back of a convertible with the top down with a cigar out of his mouth. But read your books. There's really good property books out there. Do a course, but do a reputable course. Don't do any kind of spruiker course where they tell you about property investing and then magic appears at the end. They've got a brochure to be able to sell you a property. That's not proper property investing. That's not guidance. That's not good advice. So that's just trying to sell you something and flog something off a developer or whatnot.
Everything you were just talking about is what scares me about property investing, because I feel like it's such a big commitment in terms of dollars. Even just to have like a down payment or mortgage down payment, a deposit. I worry that if I do make a wrong turn or a wrong move, I would be set back a long time. Whereas I feel like if I'm purchasing shares, even if it turns out to be a dud, the impact is not as great because I'm not investing the same amount or the same sums.
Yeah. Great point, and the more reason to do more research. You'd be surprised the amount of people that just say, I want to get an investment property, this will do. They go out, they buy something. It happens so regularly, and sometimes it's by luck, it turns out to be a good one. Sometimes by luck or unluckiness, it turns out to be a real bad one, or being put in the wrong direction, or buying something off a spruiker. There's some bad stories of property being oversold and putting someone behind. So, when you're talking big sums of money, you've got to do your research and you've got to make sure you're putting all the right pieces of the puzzle together, so to speak. So it's a great point you raised, but really important to ensure that you're doing your research when you're talking any investing at all, whether it be a smaller sum if you're buying some shares, or you're outlaying a big amount for some shares, or you're outlaying a big amount for property. It's all important to get the right research, guidance, advice, And do your background stuff.
Thanks for walking me through that, Joel. And thanks for walking us all through that, I should say. I reckon we've covered like the basics of Property 101. Is there any other major things that you would point our listeners to?
No, I reckon if anyone has any questions off the back of that, just reach out and throw them out there, and we'll try to cover them off in the future podcasts. So let's get to some Q&As now from a couple of listeners that have sent through some Q&As for us from last week.
Yep, we can do some Q&A. So
Arnie, can you start us off, Arnie? We've got one about a good amount to get started in shares. So what do you suggest is a good amount to get started in shares?
Yeah, this came through from Combo Code, so cheers for the question. I think when you want to start investing in shares, it's an individual preference first of all, but the one thing you want to be mindful of, which is what we touched on last week, was the fee structures. So if you're investing small amounts, a lot of what you're investing is going to be eaten up by fees. So it might be more prudent to sort of build up a bit of a cash reserve and try and invest that same amount at a regular interval. So you might want to say build up your cash for 2 months and invest it, or build up your cash for 3 months and then invest it. Other people, it's very hard to say what a good amount is because it's going to come down to the individual. But I would just be mindful of the fees. So I hope that's not a cop out, Jolie.
No, that's right. We've forgot to mention as a disclosure, all this chat and general in nature. So general advice in nature. So whenever we're talking about these Q&As or answering listeners' questions, which is awesome, keep them coming in. It's always general in nature. But I think you've mentioned there a good amount. Be careful of your minimums, because if you've got your minimums there and the costs erode part of that minimum, it can really set you back again. When we talk about you've got to then make up that percentage to even get back to square again.
Yeah, that's exactly right. And I got another question for you, and it was, can you give us the high level view of what's the difference between a financial advisor and a broker?
Yeah, great. So we might actually, I reckon, cover this one in greater depth, or we'll probably end up bringing on guest speakers during the podcast. We might do a week, for example, where we talk about, we get a broker in. We might do a week where we get a mortgage broker in. We might try and do a week where we get an accountant in, advisor, all those property, expert or advisor. We might get a real estate agent. So we can try to do weeks where we get special key topics in. But as a question, yeah, great one. So a stockbroker will generally do just that. They'll tend to stick more with stocks. You'll go in there knowing what the advice you're going to get is going to be directed at direct stocks. They'll generally be able to advise you, go through a risk profile, go through what you're after, and you'll have to have a certain sum of money to warrant getting the stock advice and obviously pay for their brokerage fee. And they'll end up managing, your portfolio for you and helping you give you stock tips over the period to buy and sell. And they'll just charge a brokerage fee each time they do that. And the aim is to hopefully grow that value of money over time. Did I miss anything there in the stockbrokers, Arnie?
No, that's it, mate. And you might want to say that traditionally, like brokers, as we were touching on last week, it used to be a bit harder to get into. Now there's like lower barriers to entry with brokers, and there's a whole range of, no service to full service, and the fees they charge are going to reflect that.
Yep. Cool. Yeah, absolutely. So, so that's a broker. And as an advisor, probably a little bit different. You've got transactional advisors that might be, give you intra-fund advice. So, for example, specializing in super, or give you advice on risk insurance or personal insurance, such as income protection. There you go. Could be another topic we talk about. So that could be an advisor that does transactional advice. They might specialize in aged care or SMSF. And then you've got your principal advisor approach, which is where you take more of a full picture view or a holistic view, which is probably the space that we play in a bit more at our company, where you'll actually have to be understanding and have a knowledge. It doesn't have to be an intimate, low or deep level knowledge of a certain area like stocks, for example, or stockbroking. But you'll end up bringing in specialists to help in all those aspects. And you have to be, as the principal advisor of that client, be able to understand and try to bring together all those areas for them. So you're helping them manage their cash flow, get from a period to achieve a certain amount of goals or money or objectives, help them out with complexities, and essentially work as their advocate, working for them to be able to achieve what they're after, and what their goals in life are, and what complexities they might be experiencing, whether it's in them as an individual or as a couple. And you tend to bring in specialists to help. So you'll guide them and advise them, and you'll do it unconflicted. So you'll bring in with no kickbacks or anything like that. So you'll bring in stockbrokers to help with the share advice potentially. You'll bring in mortgage brokers if we need some lending advice. You'll bring in estate planning specialists to help with that area. So you'll actually be probably the principal advisor in the middle of all these different offshoot arms, if that makes sense, as an advisor.
Yeah, I think that's a really good breakdown of the difference between advisor and broker. We've got
you take their whole life into perspective. So once you bring in all those areas, then you essentially work on your projections with those clients, and you generally have a relationship where you'll speak to them throughout the year, and you'll meet yearly for your review, and you'll ensure that they're staying on track and online on the right path. So you'll be able to sort of provide them advice and guidance, putting all those things into a plan and ensuring they stick to it. So that's more of a holistic, high-level view of the difference between advisors, brokers, but there's all different facets in there. So sorry to cut you off, Arnie.
That's all right. I think it's worth highlighting that a financial advisor is going to focus on more than just your investment portfolio. And I know you did touch on that, but just to spell it out, things like estate planning, things like budgeting. A financial advisor is going to be an expert in all aspects of personal finance, where a broker just focuses on your portfolio.
Oh, and a great difference, Arnie. Sorry, one that just highlighted to me the other week was, if you're going to see a broker, you're generally going to have some money to invest and put into stock, some form of money. But if you're seeing an advisor, you potentially could see an advisor with little to no money, but good cash flow, but you're struggling managing your money. So you might come in almost in the negatives, or in the negatives in certain cases with clients. It's happened numerous occasions where they're paying to get themselves into a better position because they're struggling to manage money. Just like you might struggle to keep yourself fit, so you pay a personal trainer because you struggle to keep accountable. Not everyone's great with keeping fit. Not everyone's great with managing money. So everyone's got different aspects and different ways they walk in life. It's completely to the individual.
Yeah, that's a great analogy. That's a really good way to think about it, because people are all starting from different bases, and it doesn't matter where you are. It's about what you're going to do over the time horizon. We always talk about time horizon. You could be starting from your own base, and you don't need to compare yourself to anyone else. It's just set your own goals and work towards them.
Yep, absolutely. So
we have two more questions. I think one question coming from Chris K, and we appreciate the question, was could we address business cycles and the central bank involvement on creating artificial booms, most notably last year's bull run? I feel like that question is a really big question. And to talk about that in just a simple Q&A, we wouldn't do it justice. So we might park it, Chris, and we might address that later in a more wider episode if we can.
Thanks for your question, Killer.
Yeah, thanks, mate. But then the last one was, I think, a really great question, which we can sort of delve into as a hypothetical, general in nature. But do you want to walk us through Carl with a K's question?
Yeah, so Carl with a K wrote in a question to us, which is a great question. And I think people will definitely go through a situation like this in life. And I think the averages for Australia is 40% breakups and whatnot, so divorces. So, Carl with a K came off the back of a breakup and essentially received some money from a settlement, from a property settlement. So then it's sort of like, well, okay, we've got a bit of money, or a decent, substantial bit of money from a property settlement. What's next? What is out there to be able to look at doing with a decent figure of money for someone that might be in their 20s or 30s that it does, or 40s, it does happen. You have breakups, and you essentially have to reset and remove through life for yourself. So, Arnie, did you have any thoughts on this one?
Yeah, I think what springs to mind initially for me is where I'm comfortable investing the money, and it would be in stocks. And I think if you've got a large, sizable amount, then I feel like I would put the majority of it into ETFs or a managed fund, just something that's passive. I don't need to worry about, and I know I'm going to get a good return, and that money's going to be relatively safe. One thing which I also might mention, and we probably could have touched on this in Property 101, but it's probably a good thing for a later topic as well, is real estate investment trusts, or REITs, which is a way that you can own property in different sectors like commercial, industrial, residential, but you don't have to own the property yourself. It's like buying part of an index, and you get the payout from that each year because they're required to pay out very high amounts of the cash flow that comes back in. So that's probably where my mind goes straight away. What about you, Jolie?
Yeah, there's got a range of different areas that you could look at, and we could sort of flesh this out all day, or talk and expand on a topic like this, and we could even do a podcast on, if you had X amount of money, where would you go, or how would you do it? So I think, behaviourally, it's one of those things. Is what's your plans from a situational and a behavioural standpoint? What's coming up for you? What are you looking at in the future? Is it to get back into a principal place of residence, which is your own occupier home? Is it to live with your new partner, for example, and live in their place? The thing with money is you got to be mindful that you can always erode over time. So if you're sitting on the sidelines too long and you've got inflation running at, let's say, 1.92%, which is where the purchasing power of your money, the cost of bread goes up every year, and you're sitting in the bank earning 0.5%, you can guarantee yourself you're going to get about a 1 to 1.5% loss on that money every single year that you sit on the sidelines. And procrastination is a big thing for someone, and a big hurdle for people sometimes to be able to get in and get invested. So it's all about planning your path ahead. And I know that changes for people. It changes. It could be a path one year, could be different to the next year. And that's why we say when we do a plan, it can generally expire pretty quickly, because you need to never assume, and you always need to move on to where your next stage is in life. So it could be something like, okay, well, do you want to buy a principal place of residence to be able to move back into one day and borrow some money to do that? Do you want to put it in cash on the side to be able to eventually do that at some stage, or park it, just bearing in mind that inflation will erode that money? So being safe in cash is not necessarily safe over the longer term. Or is it getting into some shares, like you said, or a basket of stocks? There are a few different areas that you could look at: managed funds, ETFs, just to at least have your money aim to keep pace. But then we've got to be careful of time frames too. So if you've got, let's say 100 grand, and you're putting it into some stocks or an ETF, and you think that you might need that money to be able to buy a property or do something in a year's time, that's probably time frame not going to be long enough for you, because the risk is it could go well, it could go up, but it also could go averagely, and you could be down 10 or 20% from where you started if you're only giving yourself a small window. So really time frames are really crucial.
I got to say, Carl with a K, you got to listen to Joel here. I know it's general advice in nature, but your answer was so much better than mine. I should have taken that into account. It's like, it really is about what's your goal, what's your time horizon. And I feel like a broken record saying it because we say it all the time. But yeah, my mind immediately went to the safety of like liquid index funds, and because you can get the money in and out pretty quickly. But you're right. Like, what happens if you put it in and there's a stock market crash next year and you need that money, in less than 12 months? Then it's not a good option. So you really need to think about those factors. Good call.
Yep, and drip feeding money is a good way of dollar cost averaging. So when you're buying in at different times during a cycle, you'll buy high, you'll buy low. So you could potentially set something up where you're just not ploughing the whole money in, but you might be drip feeding it in. So there are a few examples, just generally nature as always, and a good hypothetical to be able to chat to, because most likely or not, a lot of people will experience a period of life like that. So it's really important to expand and extrapolate out on that, and it helps, I think, people that might have certain situations going on in their lives or they may encounter it in the future. So it's a good question. So I appreciate the question, Carl.
Yeah, cheers, mate. So I think that's all of our Q&A for the week, which leads us to my favourite segment, which is either or, would you rather, 50-50.
What's your choice?
What's your choice? So I think it's your turn. Have you got one prepared for us, Jolie?
I do, mate. I do, and I know it's a food one again, but and the reason we do what's your choice is really that is when we talk about the investments before, you've got so many different choices out there in investments that you could choose one or the other, or you could favour one or the other, or you could choose a mixture of between 2, 3, 4, 5 investments. But what's your choice is just a fun way of talking in the normal everyday life of what's your choice, and these aren't as big as investment choices, but they're big in our own way. So it's a food one again this week. So I think one of our mates actually put this on Facebook a little while ago. So what's your choice between chicken and cheese twisties? And we don't know the answer. We don't know the answer of each other leading into this, and we didn't even know the topic. Arnie didn't know the topic. So I'm hoping again we'll disagree.
Yeah, this is coming at me cold, and I got to say that I am a huge cheese twisties fan. I feel like the chicken twisties taste like dirt.
Wow. We're at opposite ends of the spectrum. I love that. So Mate, I'm not a big chips fan in general, but if I was to go to a party, for example, and they had chicken and cheese twisties, or let's just say they had cheese twisties put out, I'd walk straight past. Wouldn't even give it a second glance. I just think they'd sit there looking dry and orange, get stuck in your teeth. But if they had those cheese twisties floating around, I'd probably put the hand in the bowl, I reckon, and maybe grab a little handful of cheese twisties. And
you said cheese. You said cheese. You
Sorry, chicken twisties. Chicken, yeah, the nice golden light chicken twisty. If they were in the cupboard and it was late at night and I felt like something to crunch on, chicken twisties, absolutely. Cheese twisties, they just sit in there for 3 years and end up getting thrown out.
Man, I feel like that is polarizing to me. I just can't. I mean, I know there's a lot of chicken fans out there, so I've probably angered half the our fan base. But it's good that you went the chicken way, and that was organic. Jolie actually likes chicken, so for all you chicken lovers out there, that just highlights that individuals have preferences.
Let us know. I'd love to get a poll on that. I'd love to see where the people land. You're the people out there. So where do you guys fall? Chicken or cheese twisties? It's a massive topic.
I'll throw up a poll on the Facebook page. I'll do chicken, cheese, or save your money and invest it.
Or none of the above. But I'd love to hear from the people because it's an Australian icon, twisties. Chicken or cheese.
Or do you like one of those weird flavours when they bring them out? I can't even think of what they are, but there's other flavours, isn't there?
Yeah, has there been any weird flavour? Yeah, there must have been, but I can't think of any. But let us know. Let us know.
I think I recall there being like cheeseburger twisties at one point. Anyway.
Okay. Yeah, no question too small on the Money in the Tank podcast. Any question, it could be trivial in nature. We want to hear it. So keep listening, everybody. We appreciate your time today. Arnie, thanks for your time, my friend.
Yeah, thanks, Jolie.
Always a pleasure, and we'll look forward to catching up with everyone next week.
Money in the Tank. See you guys.
Cheers, crew. Bye.